I think one data point that helps put this into perspective is there's a study produced by both Prologis and CB Richard Ellis talks about how that every time we produce $1 billion of additional online sales, we need roughly 1.2 million square feet of industrial and logistics real estate to service that demand. So now you kind of pivot it back to that increase in sales and say, well, look, if we increased sales about 100 billion, if we were in equilibrium going into the pandemic, well, now we're 120 million square feet short of industrial real estate supply. So that's led us to, being bullish on ground up industrial in, kind of a lot of the key major growth markets, a lot of the key secondary markets, Atlanta, Dallas, so forth. We did one in Indianapolis recently. We've done one in Atlanta this year. So generally speaking, when we think about the edge of the metros, that's where we're going to be looking to do the larger industrial deals. Those are your 750,000 square foot, give or take, really high, 36-foot clear height, large truck court, kind of larger distribution centers. If you get a little closer into the metro, that's when we see those things go down below 300,000 square feet. They look a little bit more what we call last mile distribution. And so those are the types of deals that we're overall looking for.
You are listening to the Millionacres Podcast. Our mission at Millionacres is to educate and empower investors to make great decisions and achieve real estate investing success. We provide regular content and perspective for everyone from those just starting out to seasoned pros with decades of experience. At Millionacres, we work every day to help you demystify real estate investing and build real wealth. Hello, I'm Deidre Woollard, an editor at Millionacres. Thank you so much for tuning into the Millionacres Podcast. Today, we're going to talk about real estate sectors and the outlook for commercial real estate investing. Today's guest is Ian Formigle, the Chief Investment Officer at CrowdStreet, one of the largest real estate crowdfunding investment platforms. Ian is a serial entrepreneur with deep experience in real estate, private equity, startups, and equity and options trading. At CrowdStreet, Ian serves as the key decision maker for all investments in its marketplace, totaling over 450 offerings and over $14 billion of commercial real estate. Ian is the author of the Comprehensive Guide to Commercial Real Estate Investing, and he is a contributing author for Forbes. Welcome, Ian.
Thanks, Deidre. It's a pleasure to be on the podcast today.
Ian, I'm really excited to chat with you today. I've heard you speak before on commercial real estate investing, and I know you have decades of experience. How did that prepare you for the disruption of 2020?
Deidre, that's an interesting question because you could argue in some ways that there's nothing that could have prepared you for what happened in 2020, given that I feel like we're in a once in a multi-lifetime occurrence. But what I would say was that if we go back to March 11th, the date that the CDC labeled COVID-19 a global pandemic, it was quickly thereafter, within the next few days, that we came to the realization that the commercial real estate cycle leading up to that point had just ended, that we were entering the beginning of a downturn. We didn't know what that would look like, how deep it would go, or how long it would last. But we knew we were going into a downturn. And I think then reflecting upon previous cycle experience, you knew that downturns lead to troughs, troughs lead to bottoms, and lead to the emerging of the new cycle and growth ahead. And so it just mandated that we quickly get very prescriptive about what we were going to do. We had to stress our entire portfolio. We had to quickly assess what opportunities out there no longer made any sense when we jettisoned those from our pipeline. We had to identify what handful of opportunities would continue to make sense, possibly even thrive in the market that was coming, and pounce on those, and then continue to learn and adapt as quickly as possible. And so I think it was, taking lessons learned from the last cycle, the GFC. I operated through that cycle, and thinking about what happened, how it happened, and what it would take to get to the other side of that. I think one key thing stands out is that underwriting during that period really did amount to kind of staring into the abyss, looking at assets on an absolute price per pound basis, price per square foot basis is what we would actually say, and making some fundamental beliefs that if the market would someday return to normalcy, and if the asset that we were looking at today would look very attractive, if the market would one day return to normal, and that deal made sense, that was how you started to look at deals through the early to middle part of the pandemic. So I do think that having some background in living through the GFC and experiencing what happened during that cycle really did help us navigate 2020.
Interesting. Well, I had a chance to read CrowdStreet's investment thesis, and that's one of the reasons that we all wanted to do this episode on sector-specific investing, because I think, this year more than ever, the sectors in real estate have varied so dramatically. So before we get started in talking about the specific sectors, do you have any advice on how investors should be thinking about investing in different sectors in general?
Yeah, Deidre, that's a great question right now, because you're correct in that we are seeing unprecedented levels of asset pricing dispersion across the various asset classes. And there's really no one way to look at a market right now. And there's no one way necessarily even to look at an asset class right now. For a couple of them, there's vast similarities. But it really is going to vary market by market and asset by asset right now. And so I think maybe the recommendation is to start with really assessing what's happening there. One thing that I think that has benefited us so far in terms of a perspective is that, commercial real estate experts typically want to start getting into a lot of the nuts and bolts, the metrics of a deal really quickly. But in times like these, taking one step back and taking a little bit of a 30,000 foot approach and really boiling down an investment opportunity to the basics of what are we talking about here? If this asset is going to perform, what are the basic fundamental assumptions that we have to buy into? Is it that people are ultimately going to return to this office to work one day because they're not in it right now? Is it that people like to live in this property today and they want to live in it more going forward and they're going to be willing to pay more rent going forward? Is it people are going to return here to shop one day, right? I think starting at those just basic fundamental questions will help an investor, I think, begin to get a sense of where they want to look to invest. Because it's really powerful to understand that once you start getting into a lot of the assumptions of a property underwriting and what we call an asset pro forma, they all tie to those basic things. Are people going to travel again? Well, we think yes, but when? How will they travel? Where will they travel? And what will that look like? Just thinking about those things at that kind of holistic macro level will really help guide your own investment thesis as you start to choose individual investments.
Well, you just mentioned travel, so you perfectly set me up for the next question, which is about hotels and hospitality. I mean, it's been the roughest year for hotels. We look at revenue per room is still not bouncing back. I mean, we've seen some what I would call road trip travel, but overall flights are way down. We've seen cities like Las Vegas get really hard hit. So what are you thinking about hotel and hospitality? And are you seeing any hope there?
Well, I'd say the good news is we do see some hope down the road. But to your point, Deirdre, we did see a historically unprecedented, level of distress come to this asset class. I mean, and so for example, when we talk about that revenue per room, right? So what we call RevPAR in the industry, that essentially means you take the occupancy rate of the hotel, you multiply that by the average daily rate, and that's going to get you the RevPAR number. That number dropped across the whole country, across the industry, 80% from March to April. That's just never happened before. It's never happened in any of our lifetimes. It's never happened in the history of like hotels in the United States, as far as we know. So that I think that just kind of puts it in a context that we are in a once in a multi-lifetime type of event. So what was hopeful to see was that from that period of April to September, in April, it was as bleak as you could possibly get. Certain hotels were down to like 5% occupancy. They were essentially just absolutely empty. But from April to September, you did see this steady 8% week over week climb in in occupancies and RevPARs. We got to retrace about 30% of that drop. We're now back to about 50% drop on a year-over-year basis. What's at least a little bit hopeful now is when we kind of got to the September period, we did see a flattening off of that recovery, largely due to the fact that we burned off the summer season. People weren't driving for vacation destinations anymore. School or online school was starting again. And so you saw that tail off. Now, just in the last couple of weeks, one thing that we look at is the data provided predominantly by STR. That's a national leading provider of hotel industry research. That data is always going to be a couple weeks trailing, but TSA throughputs are up to the day. Just this last week, we saw TSA throughputs spike again, exceed over 1 million passengers for a single day since the pandemic began, and saw that percentage, which had basically gotten up into the low 30% of the same weekday last year, now penetrate 40%. So it's just stepped up. Now, the question is, why did it step up? And why now in October, late October, why did it just step up? And so what we're wondering right now is, did we just see the first semblance of the beginning of a return of business travel? That number now needs to start showing up. If it is true, we should start seeing that in terms of hotel occupancies in the next few weeks. But that's kind of what we're looking at right now. So that's how we look at the hotel space going forward. And overall, when we look at next year, well, STR, for example, they do project a 30% increase in 21 RevPAR. So the beginning of the recovery of the hotel sector is on the way, and it should gain some momentum next year. And overall, we're looking at a full recovery of the sector, essentially returning back to or exceeding 2019 numbers by 24. And so really what that translates to for us today is anytime we're looking at a hotel, it is acknowledging that it is in a state of distress and will remain so going forward, looking for capital coming into that project to ensure that it is going to see its way through to 2022 in a rough operating period between now and then. But that if we can get that deal to 22 and the pricing that we can get on the asset today is justifiable to the point, it's compelling enough to the point where we'd love to buy that today at this price, whatever that price is, knowing that we think we can restore its value by 24. Well, that's how I think you make money in the sector. And as when we look back to the previous cycle, we also know that once we did get to 2012, hotels were the first sector to recover. And that's because rents are marked to market every day. So it's going to be the asset class that leads its way into the downturn. It's also going to be the asset class that can lead its way out of the downturn. So net, I think that there's brighter days ahead for hotel. We just have some tough sledding ahead of us to get there.
I would agree with that. And you gave people two really great resources right there. One of which is str.com, which is you can see, week by week how hotels are performing, and also tsa.gov. The TSA has been providing those numbers since the coronavirus started. And it's a really good way to sort of be able to see what's happening. And both of those are publicly available. And I think that really leads us well to the next segment, which is similar retail. Now, retail went through a tough time, but I've seen in the last few months, rent collection rates have been ticking back up. Obviously, I think everyone's holding their breath for the holiday season. We already know that Black Friday is going to look a bit different. Macy's just announced that Santa's not going to be live in the Herald Square store. I mean, it's going to be a different holiday season, but are you starting to feel a little more optimistic about retail?
Deidre, so I think the answer is overall, yes, but with a number of caveats, I think, to this answer, because retail, I think, is somewhat unique amongst all the asset classes, is that I think that this is one of the asset classes that a segment of the sector will see long-term damage, potentially unrecoverable damage. But I think other parts of the sector are going to actually bounce back and maybe be stronger than they would before, because overall, what I would say is I think I see consolidation coming to the space. I think we're definitely in an environment where we said, look, we've probably seen retail peak somewhere around 2014. Retail is still going to be, and I'd say specifically brick and mortar retail is still going to be an important part of our future going forward. It's going to get increasingly, I think, intertwined with e-commerce sales. You're going to see more locations start to have this hybrid approach of saying, we're going to sell products at a location, but we're also going to accept returns from our websites at this location. That's a part of that, I think the journey of where retail kind of resettles back into, post-pandemic. It was going there, leading up into the pandemic. So one of the ways I think about this is to think about the locations of centers within markets and submarkets. And so what I think right now is that if you have the strongest asset in the submarket, you're the best location, you're kind of the premier center, I think those are going to bounce back and they're going to do well in the next sector. I think those are going to bounce back and they're going to do well in the next cycle. However, if you are the third best located center in the market or submarket, your asset may be ultimately being redeveloped into housing or storage or perhaps some other use. So I do think that there's going to be this bifurcation of the retail market. I think the best assets and the best locations do well. You probably see, net, you're going to see some square footage removed from the markets. And that's probably where retail finds its footing, as we exit the pandemic. So when we think about things like that, the asset class, or I should say the subset of this asset class that I think makes the most sense, are going to be grocery anchored centers. If you find that center, it's on a good corner, it has high traffic count outside it, it has, a good strong anchor, and it has good ingress and egress, that center is going to do okay. It's going to do fine in 22, and it can thrive in 23 and 24. And again, centers that are strong are going to have the ability to backfill any vacancies that may occur right now, because every center is going to have some tenants blow out. I think that's already happening. It's going to continue to happen. But coming out of the pandemic and back into the growth phase of a next cycle, it's like those assets are going to have the ability to absorb tenants that want to come out of other locations. They might have been in the second best location in the last cycle. Now they have the opportunity to jump into the best location. So you're going to watch those rebound, lease back up, and do well. And again, it kind of leaves that outer ring, the marginal, weaker centers, kind of left to wonder what they're going to do going forward. They're going to do things like perhaps gain tenancy, but it's not going to be credit tenancy. That's going to lead to an increase in cap rates on those types of centers. We've seen that happen in many cycles before when an asset deteriorates in quality and it has to kind of find its way with a lower category of tenants, what that happens to pricing. So I think that's going to happen in this space. So, that makes us bullish on some parts of retail and very bearish on others. And I think that's just kind of part of where we sit as we come out of the pandemic.
I think that makes a lot of sense. One of the things that we're keeping an eye on too is those, like you mentioned, those Class B and C malls. They're just, some of them aren't going to make it. They may end up being Amazon fulfillment centers or, storage or warehouse or anything. I've seen a couple of instances already of malls basically being returned to the lenders already. So we may see more of that going forward.
Yeah, we've definitely seen that, and we'll see more of it going forward. And I think to your point, when you're looking at those types of scenarios, you're buying them. If you buy them, you're buying them at what you perceive as land value, because that's essentially what you're buying. You're buying a short-term, whatever residual stub of revenue that you ultimately think goes away, so that you can repurpose that location into a higher and better use in the future.
Exactly. So the next sector to talk about is medical. And medical is really complicated this year, I think, because one of the things we've seen in investing in REITs, which is obviously different than what CrowdStreet does, but you have some of the REITs that have senior housing and medical office and things like that. Obviously, senior housing is, has been a sector that has taken a lot of hits, partly because of what's been happening with COVID-19. But one thing to like about medical offices is those long-term leases. We've seen a lot of interest this year in life sciences. What are you looking at in terms of investing in healthcare real estate right now?
I'd say overall that we like healthcare real estate. It obviously depends on where it's located and who the tenants are. During the pandemic, we were very focused on needs-based healthcare real estate. So, for example, we did have a portfolio on our marketplace earlier this year that was it was a multi-location, so about 10 locations around the DFW metro. And it was all renal care. So, as anybody who has intimate knowledge of this to know that dialysis goes on no matter what's happening, a pandemic or not. You need to go in for dialysis if that's the care you're seeking. And I think that case study kind of applies to the types of uses of medical real estate that we were seeking to do during the pandemic. Essentially, the types of uses that you were going to continue to see, occupancies remain viable no matter what. Coming out of the pandemic, we broaden the scope of what we like in medical office. We're looking, for example, at a medical office deal right now, just in the greater Washington, D.C. metro area. When we think about medical office, we think about things like, transportation. Where does it sit? Does it have the ability to get to it via public transportation? That helps. Obviously, parking ratios are really important, and who your tenants are. To your point, Deidre, the weighted average lease term of those tenants is really important when we're thinking about the uses of it. But I would say, and also I think there's a bit of a theme that we embarked upon earlier in the phase of the commercial real estate cycle last time on the marketplace that we will look to do again in terms of the proximate to the major medical centers, either hospital or a district. We even had a deal on our marketplace earlier this year that was kind of keying off of a redevelopment within a major medical district in Miami, basically the medical district in Miami. And so those are the types of opportunities that we like going forward. We like the ones that are situated in medical districts, have strong tenant rent rolls, have weighted lease term. The cap rates sit a little bit above other asset classes like multifamily. They're kind of in line overall with office cap rates, but yet I think the durability of the tenant base is obviously, I think, stronger today than your average office. And they have, we have an aging population where demographics are trending in that direction. So overall, I think the medical office space sits in a pretty good position vis-a-vis other asset classes. And so, we look to bring opportunities to our marketplace where they make sense.
Yeah, I think you made a really good point there about the aging of America. That's definitely one of the trends that is going to continue to impact that sector, because obviously people tend to use more medical services as they age, and so we are going to see more need for that, especially those things that are sort of consistent, like dialysis. So let's pivot again and talk about a sector that I think everyone has been talking about this year, which is industrial real estate. I mean, e-commerce has been obviously in hyperspeed. It's like we can't build enough warehouses at this point. So it was the fastest growing sector in 2019. I'm assuming it'll be the fastest growing sector in 2020. But I noticed in your investment thesis, you actually had some reasons for caution. And I thought that was really interesting. So I was wondering if you could go into that.
Yeah, sure. So to begin, I totally concur. Overall, we're bullish on industrial. We looked at it from the perspective that it came into 2020 in a relative state of equilibrium. Demand had been strong, absorption had been occurring. Yet we'd also seen some supply. So supply had been roughly, also depends on market by market, but roughly speaking, supply was kind of falling in line with demand, and it was keeping cap rates low. But it was also, it wasn't in excess demand. It looked in roughly equilibrium. Then the pandemic hits. And then, to your point, now we see e-commerce sales spike almost to roughly 20% of all retail sales. Kind of depends on which website and where you get your information. But net, we see that we saw roughly $100 billion of increase in online sales in 2020. I think one data point that helps put this into perspective is there's a a study produced by both Prologis and CB Richard Ellis talks about how that every time we produce $1 billion of additional online sales, we need roughly 1.2 million square feet of industrial and logistics real estate to service that demand. So now you kind of pivot it back to that increase in sales and say, well, look, if we increased sales about 100 billion, if we were in equilibrium going into the pandemic, well, now we're 120 million square feet short of industrial real estate supply. So that's led us to, being bullish on ground up industrial in, kind of a lot of the key major growth markets, a lot of the key secondary markets, Atlanta, Dallas, so forth. We did one in Indianapolis recently. We've done one in Atlanta this year. So generally speaking, when we think about the edge of the metros, that's where we're going to be looking to do the larger industrial deals. Those are your 750,000 square foot, give or take, really high, 36-foot clear height, large truck court, kind of larger distribution centers. If you get a little closer into the metro, that's when we see those things go down below 300,000 square feet. They look a little bit more we call last mile distribution. And so those are the types of deals that we're overall looking for. To now answer your part of the question about the pause in terms of what we saw in terms of some trepidation around major ports, is that during the pandemic, we saw international trade drop. There's some political, there's also economic ramifications there. And really what we were looking at is, the logistics real estate, so a lot of the major distribution centers that are located in proximity to our largest ports. So Port of Los Angeles being a good example, then Inland Empire being the industrial market that serves that, for example. So for part of this year, we were watching vacancies and demand for, large industrial space in the Inland Empire. That's a market that's been, it's a blue chip market for industrial, so it's been priced to near perfection. You had to just pause and wonder a little bit to say, hey, look, if we're bringing fewer cargo container cranes off of those ships right now, or we're bringing fewer cargo boxes off of those ships, and we're seeing a little less outflow from those ports into filling up the industrial warehouses out in the Inland Empire, are we seeing a short-term, essentially lack of demand that could lead to a little bit of distress in that sector? I think as we get to 21, and we start to see, we've already started to see trade pick up, provided that we continue to see those trends. I think that we get less concerned about that phenomenon. But it also means that we're going to kind of pay closer attention to those major markets, while generally speaking, we're more bullish on the industrial real estate that surrounds the secondary markets, because those are the ones that are actually serving those metros growing in population, should provide the underlying fundamental demand for the real estate there.
That's really smart. Yeah, I think the secondary markets are definitely a place that all of us are looking for next year. So let's use this. Now we could use this time to take a quick break. We hope you're enjoying this and every episode of the Millionacres Podcast. If you have a moment, we'd love to hear from you. Please visit millionaicrespodcast.fool.com and tell us what you think of the podcast so far, what kind of content and guests you'd like to hear, and what else we can do to help you grow smarter, happier, and richer through real estate. We are here with Ian Formigle, Chief Investment Officer at CrowdStreet, and we're discussing sector-specific commercial real estate investing. Now, we've talked a bit about this year. Ian, I want to bring you into the future a little bit. I know so much about 2021 depends on vaccines and treatment protocols for COVID-19, but let's talk about some of the trends we could see. How optimistic are you feeling right now?
I'd say I am moderately optimistic heading into 2021, and I probably become fairly bullish about Q3 and Q4 of next year. And then from there, I think we're on to the next part of the cycle. And I think, we're back into a growth phase.
So do you see that as a growth phase that's going to pick up slowly, or do you feel like that's going to be a dramatic uptick?
I'd see it's starting to, I'd say a little bit slow. Again, if I think about 2021, by the time that we hit the end of 21, I think there's some strong momentum. I I think everything that we're seeing in terms of the fiscal stimulus, I think that's going to start playing out as we start to have an economy that can function more normally. People back out doing what they like to do. We're not inhibited anymore in terms of mobility. I think that's where you start to see some real fuel behind the growth phase of the next cycle. We do have people that are projecting 3+% GDP growth next year. You take, if that starts to materialize, call it by the early to middle part of next year, leading into 2022, that's where you could probably see things really start to move, asset pricing really start to take off, demand really start to come to a lot of forms of real estate. So I kind of see it gaining momentum over the year. And I see some acceleration by, kind of starting mid-year and then heading into that year and then full steam ahead by 22.
So you mentioned mobility, and one of the things that's been happening this year, certainly on the residential real estate side, is this whole urban exodus thing. We talked a little bit before about secondary markets. Secondary markets are booming. We've seen people leaving New York and San Francisco. The rents in those cities are dropping. So in terms of housing and specifically multifamily, do you feel like this is a short-term trend? Do you feel like multifamily may be falling out of favor a little bit? We've seen some activity on the build-to-rent single-family market. What are you thinking about that?
Yeah. So the way we look at multifamily right now, I'd say is kind of roughly as follows. So first, there's no doubt that we're seeing, distress come to, the largest cities. So to your point, that New York and San Francisco are kind of leading the way down and right now in terms of what multifamily can look like on the downside. Concurrently, we're seeing 4% rent growth in Nashville. So part of what I see is first, do the city's centers bounce back? Yes, I do think they do bounce back. I think that a lot of the current, uninterest in living in the core, as we can, imagine, is tied to the fact that there's not a lot of vibrance in our city cores right now. And so knowing that, leases are a 1 year type of commitment, typically speaking. So if you think about the next year to say, look, for a lot of part of the next year, this is not going to be that exciting to live here. Yes, I mean, and if I don't live in a city core, but I live, near a city center, it would be tough to live in the city center right now. If I'm living in the city right now, in the center of it, I'm probably looking to move just outside of it for a period of time. I'll probably take a wait and see approach. But if the lifestyle return that I found attractive, it's at that point that I'm going to go back. So I think when you equate that to time, probably look for, urban multifamily to start to recover and bounce back really kind of like by 2022. In the near term, I think you're seeing an excess movement towards the suburban real estate right now, just for the obvious reasons. I think that momentum is a blend. Some of it may seem a little bit of a petering out a little bit in terms of when things do get back to normal and city centers start to look a lot more attractive. But however, I do think there are underlying, demographic drivers that will continue to stay in place. You mentioned the build to rent strategy. That's probably I think that's almost like our number one housing strategy right now. We love that. We've put it on our marketplace earlier this year. We just took a deal down on our marketplace just today, for example, just filled up a deal in that sector. We love that space. I love it because it is playing into that demographic trend. Millennials, they're now 30 plus age older or on average. They're, now typically speaking they have partners, they have pets. They would like to have space for their pets in a backyard versus a balcony. The idea of having your own door you can come in and go from rather than a corridor leading to an elevator. These are all things that, that are desirable. Having your own walls, having your own roof rather than somebody above you. As the millennial demographic ages into their 30s more and more, which is going to happen, this cycle, that change in lifestyle of what the build to rent property offers, it's attractive. It's, It's an apartment style amenitized project, right? It's going to have all the types of bells and whistles that you want. It has the pool, the clubhouse. It's going to have the dog park. It's going to have the things that you would want. It's going to be, professionally maintained, and it's going to give you a bit of a single family lifestyle, and it's going to give it to you at an affordable price. It's at a rent that's commensurate with what, a 2-bedroom apartment was going for closer into the city, but yet now you have more space. I think those things are all going to resonate. I'm seeing anecdotal evidence all around me that suggests that will be the case. And so I think that's why that space has a lot of tailwinds behind it going forward. And I think the kicker on this is that in cycles past, when we saw people age into this age demographic, this is the time when they start thinking about buying homes. And there are people now buying homes across the country, right? The one thing I think the pandemic has done, which has benefited a lot of 30-somethings out there, is that they're saving at a rate that they weren't accustomed to, and that's helping them save some down payments on homes. Partially why we're seeing single family residential so strong out there right now. But for a lot of other millennials, they also still have high levels of student debt, and that's what's different about this population and this demographic than was in prior cycles. So from that standpoint, I think that you're going to see a little bit of stickiness to the rent model. It's affordable. It delivers, a single family housing type of lifestyle, but it also does it with, like I said, nice amenities around you that are attractive. And so I think from that standpoint, we just think that business plan makes an abundant amount of sense. We'll continue to do that going forward. And then as well, I think we would see, and we do seek, suburban located multifamily properties, kind of on the higher Class B towards Class A end of the spectrum. Those are the ones that are holding up really well in terms of month over month, occupancies and rental payments. And I think they've got they've also got some tailwinds ahead of them, as this kind of resettling into the, what I would also say is the inner suburb. I think the outer suburbs, are still a little bit of a question mark. But we also did see that a lot of inner suburbs were becoming more and more desirable. They were, ULI coined a phrase last year called hipsterbia, essentially saying that, hey, what do you really like about being in an urban environment? Well, you want to go to a cool restaurant. You maybe want to go to a craft brewery. You want to, have a walking environment with a lot of vibrancy around you and great common areas. Those types of things have been showing up in our inner suburbs now this last cycle. A decade ago more, you really did have to go into the city centers to kind of get that vibrancy. We're now creating that on a slightly smaller scale in a lot of, next ring out locations. So I think when you think about from a multifamily perspective, if you can take that multifamily property, put it in a location that's near one of those next outer locations, but it can give you enough of a feel of the urban vibrancy that you desired and were seeking out years ago. But now maybe the schools are better, maybe now the lifestyle is just a little bit easier. I think that makes a lot of sense. So I think that's one of the reasons why we're bullish about multifamily in those types of locations.
Yeah, I think that's really interesting, especially because the millennials obviously are a huge influential group. And you also have on the other end, you have the baby boomers who are aging, and that's a huge influential group. And those two groups, the ways that they act in the next few years are really going to impact real estate in just about every single sector. So as we wrap up here, one sector we haven't talked about, we've sort of talked about it a little bit, but not really, but it connects to housing, which is offices. So are you feeling optimistic that offices come back in 2022? Are you feeling like that's more like maybe a 2023 or even further proposition?
For office, I think that next year is the year. So call it mid 21 to early 22 is when we're going to start to understand a lot about what the future of office is going to look like. Right now, we have office properties that are still collecting rent, almost at the rate that they've always been collecting rent. And I think really what that tells you is you've got tenants in those properties that are still viable. You've also got a complete acknowledgement on both sides of the equation that nobody knows exactly what anybody wants. And so right now, renewals look like 6-month renewals. So to me, that's just a kick the can. We need to get post-pandemic to begin to see what's really going to happen to office. We've all got our thesis about what's going to happen to office, but I think kind of rubber meets the road, so to speak, sometime probably around summer of next year. In the short term, I think there's no doubt that in the city centers, there's a level of reset that's coming. There's some sort of varied level of distress that comes to the asset. It will be very case by case specific because, as you can imagine, some properties in the urban core, they're full of strong tenants on long-term leases. And if their weighted average lease term is 5 years, then by the time that their property has a material role in its tenant base, we're going to be so far into the next cycle that a lot of this will be ancient history. It's properties right now that were kind of they were a little bit weaker in the core. They had some vacancy. They had shorter term tenants in place and they have more exposure. That's where I think that you're going to see the distress. And I think those are the ones that you're going to see some price resets. And there's no doubt that New York and San Francisco, like we're seeing in the multifamily sector, are going to need to probably experience some reset in their office sectors because asset pricing was just so high. Essentially, what we say is kind of price to perfection in the last cycle, that they're the ones that are most vulnerable. Meanwhile, locations like I'll use Nashville, for example, I think they're going to do fine. They were surging in demand. But the demand was an underlying draw of people and jobs into that location. So that doesn't change because of COVID. If anything, it accelerates because of COVID. People are now deciding that it's time to kind of get on with the next phase of their life. We're seeing this kind of migration pattern start to occur. And if anything, some of the markets that we saw accelerating in terms of demand, well, now they just saw their next kick up in terms of that level of acceleration. So essentially, the same markets we kind of liked before, we like better now in a way. Coming out of 21, so if we say that part of the cycle, office has got to go through some level of true price discovery and some disruption in 21, probably settling down in 22. It probably suggests that, buying opportunities are going to show up next year. Like I said, I think it will be case by case. It'll be depending upon location. You can't say that all markets are going to be distressed. I do think that office will come back, to answer the question, does office go away? Are we all going to stay in our Zoom environments indefinitely? I don't think the answer to that question is yes. I think it's no. I think you probably see some acceleration in terms of office occupancies and people wanting to figure out the new build and what that looks like, probably around the time that we have the majority of office workers back in the office. So, for example, during 2020, it's been fair to say that a lot of us out there, I fit into this bucket. We've been able to do our work about as well as at home as we did in the office. But I think the reason for that is because everybody else is out of the office too. So the Zoom environment's great when everybody else is on Zoom. Now go to an environment where the majority of the people are back in the office. I've called in and participated in Zoom. I've been on the road enough during the previous years to understand that's a poor experience. You miss out on so much. Somebody says something, you don't know what somebody said. Somebody turned to another person and just made a comment. There have been literally meetings where I just said, I get it. I am in Nashville, for example, and the meeting is back at, my exec meeting's back at home in Portland. I should just not even be here because it's just frustrating to not really understand what's going on in that meeting. I probably should just get the notes afterwards and just kind of do a debrief with somebody who attended. I think once we get to that point, that's when you see when those people want to get back into the office. Now, will everybody come back? No. I think 20% of people or thereabouts will remain remote indefinitely. We're going to see office change in terms of how it looks and feels. It's going to have to kind of adapt to the next model. The 100 to 125 square feet per employee model is probably gone for the near term. It's gone indefinitely. I don't know when it comes back. I don't know if it comes back. But we're going to probably figure out how we're going to make offices vibrant again and attractive to those workers. That's probably going to lead to more space, obviously. And so net, that to me tells me that there's demand there for office It's just going to take some time to kind of figure it out. So that's how we look at office. So, and how we will look at it going forward. We have to be cautious about it in the short term. But if we can see pricing that looks really compelling, then we're buyers there, and we see that as opportunity in the midterm.
Interesting. You used the phrase price to perfection a couple of times. And I was wondering if you could just explain for people a little bit of kind of what that means to you.
Yeah, sure. When we say price to perfection in the industry, it is when you look at a portfolio pro forma, say it's a number of properties, and you see this whole pro forma, assume everything goes well. Occupancies stay above the market average for the next 5 to 7 years. Rents grow at or above the long-term average steadily for the next 7 years. You have expenses that remain low for the next 7 years. Like, there's all these different levers that you can pull on in a pro forma that will either increase returns or decrease returns. At the end of the day, you're buying a property for a price. You have to sell it for a price. You have to operate it in between. You're trying to figure out how much money you can make operating it. And that's a portion of your return. The rest of the return is what we call through the reversion, and is essentially selling it for more than what you bought it for. If you have to pay a price for a property that is so high that the only way for you to really justify selling it for a reasonable profit in the future is that everything in that property goes better than it's ever gone, and that we reach rental rates that we've never achieved, and we see growth rates that are above the historical norms, and they have to remain that way. Well, if you start adding all those up, you just have to ask yourself, what's the probability of all of those things occurring? Is it possible? Of course, anything's possible, but is it probable? And I would say that history has taught, people in the industry cycle over cycle to suggest that it doesn't all work perfectly all the time for 7 years. It just doesn't really ever happen. So when we say price to perfection, we're talking about assets that have reached these levels of pricing, and where that's the type of underwriting that you have to assume in order to hit a desirable rate of return, by disposition. And so it's in those scenarios where we step back and say, I think the more likely scenario is that something's going to go wrong here, and that there may be a time in the future to buy this asset at a price that looks maybe similar to today or maybe lower than today, but that will get priced in such a way that now we think we have a better probability of achieving that desired rate of return, because we don't have to do everything perfectly going forward in order to hit it.
Interesting. So like the opposite of that would be like, price to reasonableness or something like that.
Price to large margins of error. Those are the deals that we love. That's a typical distressed underwriting. This asset's really beat up. You're getting it for a huge discount. You do have to make a bunch of assumptions, but then you price in huge margins of error to be wrong. And if you can still make a pretty good rate of return and be hugely wrong in a deal, that's the type of deal that you say, that's the one that I would want to go into.
Absolutely. So, obviously I know CrowdStreet looks at probably hundreds of deals every year. I know that you only put a very small amount of them actually up in your marketplace for people. So given that, if you could sum up kind of the investing goals of the platform for the next year in one sentence, what would that be?
The goal for the next year is to return to a reasonable rate of velocity. It is to seek the best operators and developers around the country, and to partner with them on bringing what we think will emerge as being some hugely attractive investment opportunities, in 21, as we really get into the next part of the cycle. Remember, commercial real estate as transactions are down 70% year over year. So we're in a supply constrained transaction environment. As some of those start to turn around, that's where I think you're going to start to see some real interesting opportunities emerge.
Absolutely. And last question I want to ask you is, Obviously, you work with a lot of experienced investors, but do you have advice for someone who's just getting started in commercial real estate? Is there something that they should be doing as they start to learn about the space? Is there anything that you wished you had known when you were starting out?
I think the number one thing that new investors can really spend time on, first and foremost, is to really just look at the quality of the operator or the developer. I feel like new investors oftentimes on our marketplace, they quickly gravitate towards the asset, the returns. They really start to look at the deal. And I can tell you over, a long time of experience and working with the best groups and working with groups in between, is that you cannot overemphasize the amount of importance you should place on the quality and the capabilities of that operator or developer. A great deal with a mediocre operator will have an okay outcome, could have a bad outcome. An okay or mediocre deal in the hands of the best operator out there will typically have a good outcome. And so the market of commercial real estate is so inefficient compared to equity markets. And that inefficiency plays into the advantage of the best in class operators. It plays to the disadvantage of the middle players. It plays to the vast disadvantage of the weakest players to the extent that they get exited from the market. So really start with that operator, understand them and what they've done and where they do it, and know that you're first and foremost making that decision based upon them. Then you want to understand the deal. Then you want to get confidence that what they're doing is the thing that you want to do with them. And if you take that approach, I think you do better on average than you don't.
That is really good advice. Well, Ian, thank you so much for your time today. And just a reminder to our listeners that you can find the CrowdStreet investing thesis at crowdstreet.com. It's a really good, fast read. It's a nice overview of all of the different sectors, and just a lot of really great thought went into it.
So, Deidre, I just want to say thank you for having me on the podcast today. It was a pleasure to chat with you.
Thank you for tuning in to the Millionacres Podcast. I hope you liked today's show. If you enjoyed this episode, please consider subscribing through your favorite podcast provider. And if you have any questions, please feel free to drop us a line at help@millionacres.com. Stay well and stay invested. People on this program may have an interest in the deals, offerings, or services they discuss, and Millionacres or the Motley Fool may have a formal recommendation for or against. Always consult a certified tax professional before acting on tax advice, and do not buy or sell assets based solely on what you hear.